Why avoiding mistakes is key to investment success. Welcome to today's video. Investing is one of the most effective ways to grow your wealth, but it's also an area where many people make costly mistakes. These errors can not only slow down your progress, but sometimes even result in significant losses. The good news? Most of these mistakes are avoidable if you understand what to watch out for. In this video, we're going to cover 5 common investing mistakes that you should avoid at all costs. Whether you're a beginner or someone with years of experience in the market, these insights will help you protect your hard-earned money and make smarter financial decisions. From timing the market to staying diversified, we'll break down each mistake, explain why it's harmful, and show you how to avoid it. By the end of this video, you'll feel more confident about your investing journey and be equipped with actionable strategies to grow your wealth effectively. Let's dive in with the first mistake, which is something that even experienced investors struggle with: trying to time the market. Mistake number 1, timing the market instead of time in the market. One of the biggest mistakes investors make is trying to predict when the market will go up or down. This is called market timing, and while it might sound tempting to sell when you think the market is about to drop and buy back when it's about to rise, it's nearly impossible to do consistently. Studies show that even professional investors and fund managers struggle to time the market accurately. Missing just a few of the best performing days in the market can drastically reduce your overall returns. For example, if you invested $10,000 in the S&P 500 over the last 20 years but missed the 10 best days, your returns would be cut in half. Instead of trying to time the market, focus on time in the market. This means staying invested over the long term, regardless of short-term fluctuations. Markets tend to recover from downturns and grow over time, so the longer you stay invested, the more likely you are to see significant gains. The best way to avoid this mistake is to stick to a consistent investment strategy, such as dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. It takes the guesswork out of investing and ensures you're always building your portfolio. Let's move on to the second mistake: failing to diversify your portfolio. Mistake number 2, failing to diversify your portfolio. The saying, "Don't put all your eggs in one basket," applies perfectly to investing. One of the most common mistakes is putting too much money into a single stock, sector, or asset class. While it might be tempting to bet big on something that seems like a sure thing, this approach is incredibly risky. For example, think of the tech bubble in the early 2000s, or the collapse of individual companies like Enron. Investors who were heavily concentrated in those areas lost significant amounts of money when the bubble burst or the companies failed. Diversification minimizes risk by spreading your investments across different asset classes, sectors, and geographic regions. For instance, instead of investing all your money in tech stocks, you might allocate some to healthcare, energy, or consumer goods. You can also diversify by including bonds, real estate, and international stocks in your portfolio. An easy way to achieve diversification is by investing in index funds or exchange-traded funds, ETFs. These funds track a broad market index, such as the S&P 500, and give you exposure to hundreds or even thousands of companies in a single investment. By diversifying, you reduce the impact of poor performance in one area and increase the overall stability of your portfolio. Mistake number 3, ignoring fees and expenses. Many investors overlook the impact of fees and expenses on their returns, but these costs can add up significantly over time. Whether it's management fees on mutual funds, expense ratios on ETFs, or commissions from financial advisors, high fees eat into your investment growth. For example, a mutual fund with a 1.5% annual expense ratio may not sound like much, but over 30 years, that fee could cost you tens of thousands of dollars in lost returns. Compare that to a low-cost index fund with an expense ratio of 0.05%, and the difference is staggering. The key is to choose low-cost investment options whenever possible. Index funds and ETFs are typically much cheaper than actively managed funds because they don't require expensive research or frequent trading. Additionally, consider using commission-free brokerage accounts to further reduce costs. Before investing in any fund or service, Take the time to review the fees and understand how they will impact your returns. Over the long term, even small differences in fees can have a significant impact on your overall wealth. Mistake number 4, letting emotions drive decisions. Investing can be an emotional experience. When markets are soaring, it's easy to feel overconfident and take on too much risk. On the flip side, when markets are crashing, fear can lead to panic selling. Both of these emotional reactions can harm your long-term financial goals. One of the most common emotional traps is FOMO, or the fear of missing out. This often happens during market bubbles when people rush to buy assets that are rapidly increasing in value. Unfortunately, many end up buying at the peak, only to watch prices crash shortly after. On the other hand, fear can cause investors to sell during downturns, locking in losses and missing the eventual recovery. Markets are volatile in the short term, but over the long term they tend to grow. By staying calm and sticking to your strategy, you can avoid making emotional decisions that hurt your portfolio. The best way to counter emotional investing is to have a clear plan. Define your goals, set an asset allocation that matches your risk tolerance, and stick to it. Regularly remind yourself why you're investing and focus on the bigger picture rather than short-term market movements. Mistake number 5, neglecting to reassess your investments. The final mistake is failing to review and adjust your portfolio over time. Your financial goals, risk tolerance, and market conditions can change, so it's important to regularly reassess your investments to ensure they still align with your objectives. For example, as you approach retirement, you may want to shift your portfolio toward more conservative investments to preserve your wealth. On the other hand, if you're in your 20s or 30s, you might take on more risk to maximize growth. Rebalancing your portfolio is another essential practice. Over time, some investments will outperform others, causing your portfolio to become unbalanced. For instance, if your stocks grow faster than your bonds, you may end up with a riskier portfolio than you originally intended. Rebalancing involves selling some of the overperforming assets and buying underperforming ones to restore your desired allocation. By periodically reviewing your portfolio, you can stay on track and ensure that your investments are working toward your goals. Conclusion: invest smarter, not harder. Investing is one of the best ways to build wealth, but avoiding common mistakes is just as important as choosing the right investments. By focusing on time in the market, diversifying your portfolio, minimizing fees, managing emotions, and reassessing your investments, you can protect your wealth and set yourself up for long-term success. Remember, investing is a journey, not a race. Stay disciplined, stay informed, and always keep your goals in mind. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and share it with others. Until next time, invest smarter, not harder.